Good morning, everyone. Thank you for coming to my video. This is an honor to meet you here in my video. Let me introduce myself. My name is Eka Rizky Sukmadewi, but you just can call me Ika. I am master student at IPMI International Business School. Today, I'd like to give you a brief outline of my presentation about corporate finance study. The purpose of the presentation is to fulfill the final assignment of corporate finance class by Professor Roy Sambel. First, I will explain to you the first chapter is about financial management. In simple terms, financial management is the business function that deals with investing the available financial resources in a way that greater business success and return on investment are achieved. Financial management is an important part of any business or organization, as it helps to ensure that resources are allocated appropriately and risks are minimized. Financial management consists of goals of financial management. The goals of financial management can be classified in many ways, divided into four objectives. First, basic objective, operation objective, social objective, and research objective. And here we learn about what to manage in corporate finance. In this subject, we learn to earn part to be managed at financial. Next is the corporate and financial market, classified into two parts. There are the principal agent problem and good corporate governance. A principal agent problem is a conflict in priorities between the owner of an asset and the person to whom control of the asset has been delegated. Whereas GCG is subject popular as tariff. Tariff means transparency, accountability, responsibility, independency, and fairness. Another subject in financial management that is important to the finance concept is knowing the important part of finance, including rules and restriction. Financial management also learns about the value creation principle for cornerstone of corporate finance. Here we know the value creation from customers to shareholder. Professor Ramcharan, a professor of global business and leadership consultant, through his book What the CEO Wants You to Know, explained about 5 business essentials. There are cash, profit margin, velocity, growth, and customer focus. Then we learn about 6 sources of corporate value. Corporate value is divided into 2 parts. There are tangible assets and intangible assets. Tangible assets are divided again into 2. First, physical asset. Second is financial asset. Employee and supplier asset, customer asset, organization asset, and reputation asset incorporate into an intangible asset. In this class, we have changed to make a book review. Especially, teammate and I make a book review from Warren Buffett with the title The Warren Buffett Way. Through the book, we learn about 12 tenets that are divided into 4 categories. There are business tenets, management tenets, financial tenets, and market tenets. The famous quote from Warren Buffett, he says, "Someone sitting in this seat today because someone planted a tree a long time ago." Overall, there is no better time to start thinking about that pet than today. A tree takes time to grow, and so will most smart investment. Start early, Be patient and let your money grow. Next chapter is time value of money. In other words, we also learn about the time value of money. Time value of money will answer the question, what do I need to invest today to have a specific sum of money at a future date? You can think of present value as the amount you need to save now to have a certain amount of money in the future. The present value formula apply discount to your future value amount, deducting interest earned to find the present value in today's money. Here's a method of calculating capital budget. As in PPT, capital budgeting is the process business undertakes to evaluate potential major project or investment. Construction of new plane or a big investment in an outside venture are example of projects that would require capital budgeting before they are approved or rejected. In another way, we learn about the security analysis divided into fundamental analysis and financial analysis. Fundamental analysis is an analysis that considers the things that can move stock price and in comparison to macroeconomic conditions. Technical analysis focuses on a company pattern of increasing and decreasing prices. Security analysis consists of balance sheet, income statement, cash flow statement, and the technical analysis consists of portfolio theory, variance, correlation, beta stock, CAM, return risk, systematic versus unsystematic risk. For market investor, here are the investor sentiment during market cycle. The next chapter is about capital structure and dividend policy. Many factors can influence or determine value of the company, some of which are the capital structure and dividend policy. Capital structure has positive effect on firm value because an optimal capital structure will help company performance, thereby increasing firm value. Capital structure is related to how much money or capital is supporting a business, financing its asset, and funding its operation. It also shows company acquisition and capital expenditures that can influence the business bottom line. A company dividend policy dictates the amount of dividend paid out by the company to its shareholder and the frequency with which the dividends are paid out. When company makes a profit, they need to make decision what to do with it. So what is dividend tax rate? The tax rates on qualified dividend is 0%, 15%, 20%, depending on your taxable income and filing status. The tax rate on non-qualified dividend is the same as your regular income tax bracket. Next chapter is about corporate restructuring. Corporate restructuring is an action taken by a corporate entity to change its capital structure or operation significantly. Generally, corporate restructuring occurs when the corporate entity experiences significant problem and is in financial jeopardy. Corporate restructuring can occur by looking at several indicators. First, namely financial distress. Financial distress, it can be seen the company's financial situation that is experiencing uncertainty so that it cannot pay debts and so on. The next step to fix financial distress is by taking turnaround opportunity, followed by surviving and transformation business. How surviving are? There are stop the bleeding, financial restructuring, temporary pivoting, strategic relighting, redefining core business, and the last, new ways of doing business. And the last is restructuring corporate structure with capital structure, working capital management, asset structure, revenue management, cost management, cash flow management, growth management, and risk management. Next chapter is about fraud risk management. Fraud risk management is the process of identifying, understanding, and responding to fraud risk as an organization. Fraud can only be reduced if there is a process where the fraud is detected at an early stage. Once the fraud is detected, measures have to be taken in order to mitigate the fraud. The step for mitigated. First is occupational fraud and abuse, consists of corruption, asset misappropriation, fraudulent statement. Second is a fraud triangle. Fraud triangle consists of perceived opportunity, rationalization, and perceived pressure. Last is whistleblowing system. Whistleblowing system is a system that functions to report or inform on an act that indicated a violation in the corporate environment. A whistleblower is anyone who has an reports insider knowledge of illegal, illicit, and fraudulent activities occurring in an organization. Next chapter is about international finance. International finance, known as macroeconomic, is a branch of financial economics that studies the relationship between two or more countries from a monetary and macroeconomic perspective. In international finance, there are several things that must be understood. First, foreign exchange refers to exchanging the currency of one country for another at prevailing exchange rate. Let us take a close look at the meaning of foreign exchange. Different countries have different currencies. Foreign exchange convert the currencies of one country into another. Second, arbitrage. Arbitrage is an investment strategy in which an investor simultaneously buys and sells an assets in different markets to take advantage of a price differences and generate a profit. Last is interest rate. Interest rate is the amount charged over and above the principal amount by the lender from the borrower. So this is the end of my presentation. I made apologies if I get mistaken about what I learned. Like Steve Jobs said, stay hungry, stay foolish. I hope you guys understand, and let's start our journey in Magister class. I'd like to say thank you for watching. Goodbye.